let's be honest, investing can feel, well, pretty intimidating, right? Like it's some exclusive club for people on Wall Street. But what if I told you there's a really simple, straightforward way to build some serious wealth? Okay, let's pull back the curtain and break this all down, step by step. First, let's look at a story. Picture someone starting their investment journey way back in 1985. Just 2 years in, bam, they get hit by Black Monday, the worst single-day market crash in history, but they hold on. Then the dot-com bubble bursts. They keep holding on. Then 2008 happens, and the whole global financial system nearly collapses. And of course, the pandemic crash in 2020. Through all that chaos, they just did one simple thing. They didn't panic, and they stayed invested. So, what was the reward for that incredible patience? Get this. Even with all those terrifying downturns, the average return over that entire time was a staggering 11.23% a year. That just goes to show you how resilient the market is over the long run. Okay, an 11% return sounds great, but what does that actually mean in real money? Well, if that same person had just invested $250 every month since 1985, their portfolio could now be worth over $1.5 million. That is the incredible, life-changing power of investing consistently over time. Feeling inspired? You should be. So now let's switch gears from the why to the how. And I promise you, getting your own journey started is way easier than you probably think. But wait, before you invest a single penny, we have to talk about step 0. This one is absolutely non-negotiable. You need a safety net. Your very first goal should be to build an emergency fund with about 3 to 5 months' worth of your basic living expenses tucked away. This is the money that lets you sleep at night and stops you from ever having to sell your investments at a loss if life throws you a curveball. All right, once that safety net is in place, it's really just 3 basic moves. First, you open an investment account online. There are tons of great, super user-friendly platforms out there. Second, you connect your bank account and put some money in. And third, you figure out your strategy, which is exactly what we're going to talk about next. Now, a quick pro tip when you're opening that account, use a tax-advantaged one. Seriously, this is like giving your money a superpower. It means your investments can grow and you won't have to pay taxes on the profits. In the UK, you'll look for a stocks and shares ISA. In the US, the go-to is a Roth IRA. As you can see, they have different rules on how much you can put in and when you can take it out, but they share that beautiful, beautiful feature, tax-free growth. Okay, your account is ready to go. Now for the million-dollar question. What do you actually buy? Well, for beginners, the best strategy is beautifully simple. You're going to invest in, well, everything. I know, that sounds a bit wild, right? Trying to pick individual winning stocks is almost impossible. So how in the world can a regular person invest in hundreds of the biggest and best companies all at the same time with a single purchase? The answer is an amazing invention called an index fund. Think of it as a bundle. It holds tiny little pieces of all the companies listed in a major market index, like the S&P 500 in the US. So in one click, you're buying a slice of the entire market. You're not looking for the needle in the haystack, you're just buying the whole haystack. I absolutely love this analogy. Think of the stock market like a music chart. Individual companies are the songs. The S&P 500 is the top 500 chart. The biggest, most successful companies, the hit songs, rise to the top. If a company starts to do poorly, it falls off the chart and is automatically replaced by the next big thing. An index fund basically lets you invest in the entire chart, so you always own the hits. And this gets to the real magic of it all, diversification. Your money isn't just riding on one company's success. It's spread out over hundreds of them. So if one of those companies has a terrible year, it's just a tiny blip in your overall portfolio. This is how you dramatically lower your risk without sacrificing growth. So, we have the account, we know what to invest in. Now let's make it so easy that you barely have to lift a finger. This is all about the set it and forget it approach to building your wealth. And you don't need a fortune to start. The source material talks about a cool little experiment where someone invested just £5, basically the cost of a daily latte, into an S&P 500 fund every single day. It's proof that small, consistent actions are what really matter. This quote just says it all, doesn't it? The less I have to think about, the better. You can set up automatic transfers from your bank to your investment account every week or every month. And here's another tip. When you buy your fund, look for the accumulation version. All that means is that any dividends, little cash payouts from the companies, get automatically reinvested for you, which just turbocharges your growth over time.
So what happens when you combine that simple automation with time? Just look at this. If you were to invest £250 a month for 31 years, you would put in a total of £94,000 of your own money. But thanks to the power of market growth and compounding, that could balloon into a portfolio worth over £1.1 million. I mean, that's where the real magic happens.
So, you know why you should invest, and you know how to do it. But there's usually one final hurdle that stops people dead in their tracks. It's that one little word: risk. It's the fear of losing money.
But we need to flip our thinking on this. As this quote puts it so perfectly, the biggest risk is not starting. The real danger isn't that the market will go down temporarily. The real danger is leaving your money sitting in a savings account, where inflation slowly eats it away and you miss out on decades of potential growth.
And if you need a picture of what that risk, the risk of waiting, looks like, here it is. Just delaying your start by 10 years from age 25 to age 35 can have a massive impact on your final outcome. Look at that difference. Your single greatest advantage as an investor is time. You can't get it back. So, we've walked through it all. You've seen the proof from history. You've got the simple 3-step setup. You have the winning strategy of buying an index fund. And you know how to automate the whole thing. You literally have the entire blueprint. The only real question left is, what's holding you back?